Howdy everyone, Greg Martin, the Entrepreneur's Banker here. In the last 3 weeks, we have had a really deep dive into understanding what working capital is in your business, the working capital cycle, and then defining and understanding your working capital need. And I think understanding your working capital cycle and your working capital need, and then managing the growth of your business and managing the working capital growth is so critical, but it's something that a lot of entrepreneurs haven't been trained on how to do and just don't pay attention to. I once heard of a story of a husband and wife entrepreneur that they were really good. They had a product and they were really good at social media marketing, and they actually had 2 or 3 videos that featured this product, but they actually went viral. And so they started getting all of these orders, and they thought, hey, this is fantastic. This is exactly what we've been working so hard for. But they didn't plan out their working capital need and their working capital cycle. And so they ended up actually having to go out and get some hard money lenders in order to finance these orders and everything like that. Well, because of the time that it took in order to bring all these orders in and to manufacture it, their reputation risk was elevated, and they started delivering goods like 6 months after they promised them. So all of their big orders that they thought were going to be a major, it was a godsend, it was going to change their life, actually turned out to be a curse. As their reputation suffered, they got canceled, and because they had taken the hard money lender, the hard money to actually finance that, they actually ended up declaring bankruptcy in the business. And so I'm not saying that understanding your working capital could have solved everything for those entrepreneurs, but what it could have done is they could have allowed them to grow at a sustainable rate and to make sure that they had the ability in order to support that growth. So one of the questions that I've been asked over the last 3 weeks as we've kind of gone through this course is, okay, Greg, how much working capital is enough? And honestly, it's a matter of understanding where your business is, the industry that you're in, and then what are your plans for the future. As we talked about in the previous weeks, we can actually go and define and we can quantify what your working capital need is today. And then you can put a little thought into where you're going to be in the future, and you can get a pretty good idea of where your working capital needs going to be in the future based on the growth, based on managerial decisions, based upon efficiencies, stuff like that. But how much working capital is needed? Well, first off, I want to make sure that we define and we understand the difference between working capital and strategic reserve. Remember, working capital is the fuel that the engine of your business uses in order to produce the good or service or to do operations. Strategic reserve is that money that's kind of set aside, and that's 3 to 6 months of all operating costs, all in. And that's set aside to be able to have in case of a rainy day, in case there is another pandemic, or shoot, if you're in Texas, if you have another snowmageddon and everything is shut down for a week. Secondly, a good point of reference we've been talking about the last couple of weeks is understanding your current ratio, and that is the relationship of your current assets over your current liabilities. And a good rule of thumb is to be able to have that at 2.0 or higher, or twice as many current assets as you have current liabilities. But even that may be a little bit deceptive because you need to understand the things that make up your current assets and your current liabilities. For example, if in your current assets, you've got a whole bunch of accounts receivable, but they're really aged, and you're not really sure if you're starting to have to make collection calls on that, then obviously that's not really good. If your receivables are all concentrated into one major customer, or maybe 1 or 2 major customers, and then there's a lot of risk that's associated if they either didn't pay their bills or they stopped placing orders with you, well, then having that 2.0 current ratio maybe doesn't necessarily make sense. What type of inventory you have is another good thing that you to understand. Is it something that is a commodity like an aluminum billet or lumber or plastic, something like that? Or is it some type of specialized or customized inventory that you have to have that you can't necessarily sell on the open market? So while a current ratio of 2.0 is a really good place to start, you honestly, as the entrepreneur, need to know and understand your business better than anybody else and say, okay, what are the risks even associated with that? And all that's great and perfect if you are a company that has inventory and has accrual-based accounting. But a lot of entrepreneurs that I work with don't have accrual-based accounting, and some of them don't even have inventory that they work with. And so what I would say in instances like that, it's, again, we're splitting up your working capital need and your strategic reserve. And I think that while the strategic reserve needs to have probably 3 to 6 months worth of all-in operations, if you're a cash-based business, then having 1 or 2 months, probably 2 is probably a little bit more preferred, worth of cash on hand in order to support your operations, then that's probably a pretty good indicator of what your working capital level should be. So what are your sources of working capital? Now, before we jump into that, I want to just say thank you so much for sticking with me over the last couple of weeks as we dive into understanding your working capital. And thank you for taking the journey with me. If you have not done so, make sure that you hit like on this video and send me an email at greg@theentrepreneursbanker.com to make sure that I send you not only the workbook that I developed in order to have with this course, but also the links so that you can get all 4 of the videos directly. What are the sources of working capital? I think they really come down to 3 different sources. And let's start and let's think all the way back to the very beginning of your business. How did your business start with working capital? Well, like most entrepreneurs, you probably had some cash and you injected it into your business. That's the first place that you can find as a source of working capital. That's equity injection, whether that be from a borrower, or as if someone maybe is coming in and buying into the company at a later round, like you talk about or you hear about in Shark Tank, where they sell 10% of their business for $500,000, and the sharks always ask them, well, what are you going to use with their money? And their response is, we're going to buy inventory, we're going to be able to have some type of marketing prowess, we're going to do something. And well, what's the term for that we've been talking about? It's working capital. It's to be able to inject cash into the business from the owners in order to sustain the operations of the business, either continued operations or growth. The second form of working capital is through retained earnings of the business. So at the very beginning of your business, you injected cash into it. You started to build and sell and receive cash for whatever it is that you do. And if you do it right, there's going to be a profit at the end of the day after you have sold everything and that you've paid all your expenses. So that profit can then be used to, if it stays in the business, it can be used to fuel the engine of your business further in order to do the next job and the next job and the next job. So that's the second source of working capital, and that is through retained earnings. Now, I want to talk real quickly about something that a lot of entrepreneurs don't think about when it comes time to do taxes or something like that at the end of the year, when you look back and say, man, I've had a phenomenal year. It's just been really, really hard, but really, really good. We've had a lot of profits. And me as the owner, you know what? I want to take some of that profit out of the business. I need to be rewarded for the risk that I take as a shareholder. And I believe and agree with that 100%. But you have to be aware and strategically align your distribution plan with your growth plan, with your working capital plan. Because if you take distributions out of the business, what are you going to take the distributions out as? Well, duh, you're going to take them out as cash. And if you don't have cash sitting in your bank account, well, then you're going to borrow either from a line of credit or some other type of credit vehicle, or you're going to reach into the future cash flows, your accounts receivable, and you're going to pull money out. You're going to convert that to cash, and then you're going to pull money out. Well, if you do that, then that cash is not available for your business to be able to use in order to sustain itself. And so as you're going through that, you need to understand that if you take money out of the business, and as the owner, you've got every right to do that, and you should be compensated for the risk that you're taking. But if you take too much out, then you are weakening your company's ability to meet its financial and its operational obligations. You're hurting the working capital cycle of that, and then it's going to put your business at a higher risk. So as you're going through and you're saying, okay, well, I want to retain the earnings, I want to keep those earnings in there, and I want to reinvest it into the business, that's a good thing. And that's a source of working capital. But understanding that you should take distributions out, but take them out in the right manner at the right time and be long-term focused on your business. One last thing to talk about that is that you have to understand that as you're taking distributions out of the company, you are decreasing the flexibility of your company, the financial flexibility of the company, because it's more and more leveraged because it doesn't have the assets in the business. And if you want to learn more about the different types of financial flexibility and how you can be aware and increase the financial flexibility, check out one of my previous courses that dealt specifically with that. And we talked about financial flexibility from everything from cash flow to understanding the leverage on your balance sheet to finding financial flexibility with your customers and with your suppliers. So I hope you check that out as a little bit of a bonus. And the third and final source of working capital is debt. So you've got your startup cash, your retained earnings, and then debt. And as someone that spends a disproportionate amount of their time looking at businesses' ability to take on and pay back debt, I want to be very, very clear about this. Debt is not necessarily the answer for every business. You decrease the financial flexibility that you have when you take on debt, but it can be used a very effective tool to help you sustain and grow operations. And so you need to think really, really hard, and you need to make sure that you're protected. Remember, debt is like fire. It'll either cook your steak, or if you allow it to, it'll burn your house down. So you need to be super, super aware before taking on any debt. Talk with your banker, talk with your Fab Five, talk with those that understand where you want to go and how you want to get there to see if debt is the best vehicle for you. Now, there's obviously two types of debt when we're talking about working capital structure. There are term notes, which aren't really as common as much as the second one, the line of credit. But let's talk about term notes real quick. So this is term debt that you can say, okay, I need to inject some cash into my business, and I'm going to keep the cash in my business, but I really need to have a large slug of it now. If you actually were to get bank debt in order to say, okay, well, I'm going to get this $300,000 and I'm going to pay it off. Let's say I'm going to pay it off over 3, 4, or 5 years. Typically, the terms on this type of debt are really, really short because, think about it, what you are using that debt for is to build the equity in the business. All right, you're not buying a piece of equipment or a building or a vehicle or something like that that has a useful life of 5, 7, 20 years. What you're doing is that you're taking that cash and you're going to convert that cash into inventory, into accounts receivable, into something that helps the engine of your business actually go. And with that asset, you should be converting that asset back to cash really quickly. And because of that, you're not going to typically find a lot of lenders that say, I'm going to stretch that working capital payback period over a long period of time. Now, one example or one caveat to this is that when you talk through, and if you have a very clear understanding of what you're going to use it for, if you get an SBA loan, you can have it paid back over a 10-year period. That's a pretty long time. But again, that's because the SBA is providing a guarantee to the bank, and to be able to say, okay, well, if this thing is paid back over 10 years, well, you also have the support of the Small Business Administration. But typically, what I would ask you to consider, entrepreneur, if you're thinking about that, is to really understand, okay, what's the total cost of borrowing $300,000 over a 10-year period versus over a 3 or 5 year period? Yes, the flexibility is increased because your payments are lower, but the interest cost that you're going to have on that slug of working capital is exponentially higher. So again, this is about you understanding what you're going to use the loan proceeds for and how you're going to actually pay it back. So the second debt vehicle, the more common debt vehicle, is a line of credit. And this is a credit commitment that the bank says, okay, you can borrow up to X amount. So you can borrow up to $750,000. And as long as you borrow on it, you're going to have just monthly interest-only payments based on whatever's outstanding. And then when you get paid back, when the receivables come in from your customers, then you actually are able to go and you take and you pay down the line, and the ability to borrow back on it increases. And so the following week, if you need to have payroll or you need to pay for inventory or you need to do something else again, then you can turn around and you can pay that. You can borrow on it again, wait till you convert that inventory into a good or service, and then that goes into an AR. The AR is turned into cash. You get the cash, you pay the line down. So it's a vicious cycle going up and down and up and down. And so a line of credit is often referred to as a short-term working capital vehicle. Since this is by far the more common way that entrepreneurs finance their working capital need, I'm going to kind of dig in and dive deep into this. First off, let's talk about understanding how the size of your working capital line is determined. Now, while different banks have different underwriting and approval criteria, typically lines of credit are secured by the assets that are in the working capital cycle. That's primarily your accounts receivable and inventory. Although normally I've also seen a bunch of a blanket lien on the equipment and the different intangibles in the business also pledged as collateral. I've also seen instances where you have real estate or vehicles and equipment and or maybe even some brokerage accounts or some other type of collateral that's pledged. But most of the time, if it's a true working capital line, it is supported by the assets of the working capital part of your business. So the size of your working capital line is made in relation to those specific assets. So even if you were to pledge a building and say that you were to have, a $2 million building that was pledged on it and you wanted to get a $1.5 million line of credit, well, a bank may be willing to do that, but more often they're probably going to ask something or say, okay, well, help me understand what the working capital need is. And if the working capital need, either through the current operations or the projected growth, supports that $1.5 million line of credit size, then you'll probably be more apt to get an approval on that. So you need to make sure that you can talk through with your banker or your lender, whoever it is, the need for your line of credit. And we did that exactly in the last week's episode where we talked about understanding your working capital need and how it varies throughout the year. I once heard of a company that specialized in making corned beef, and the number one holiday, for those of you who don't know, the number one holiday in the U.S. for corned beef is St. Patty's Day. So as you can imagine, if this is one of the major suppliers of corned beef in the U.S., they had to have a line of credit that was very, very seasonal. That at the beginning, probably at the end of the year, they started to build up their inventory of corned beef and to be able to start taking orders and then delivering that. So you had a huge amount of expenses that happened at the end of the year and through the first part of the year. And so their line of credit probably ramped up really, really big, and they had to borrow on it because they had to sustain operations. But then as soon as St. Patty's Day was over, they would collect in all of their receivables from their major supplier, from their major retail accounts, the Krogers, the H-E-Bs, the Publix, different brands, different food chains, stuff like that. And then they would be able to pay that line of credit down and then build in their war chest again, or their capability of being able to ramp back up next year. And that brings me to my second point. A line of credit is meant to revolve. It goes up and it goes down. It goes up and it goes down. When I first started out in banking, I started to understand, okay, how do banks see and view lines of credit? How do entrepreneurs view and see lines of credit? And there may even be a provision based upon your bank and based upon your business cycle that the bank says, you know what, you need to have a rest period. That's 30 consecutive days that you are out of this line. And to be able to understand that and to be able to say, okay, how are you using this line of credit? Sometimes that rest period makes sense, sometimes it doesn't. But at the end of the day to be able to say, okay, is it going up? Is it going down? Is it going up? Is it going down? If you have a $500,000 line of credit and the second that you close, you draw $450,000 on it, and over the next year, you just bounce between 450 and 500, 450, 500, and just kind of bounce back and forth, well, then a bank's going to look at that and say, you know what? You really don't need a $500,000 line of credit. What you need is a $400,000 term note to support that working capital need, because that just keeps getting churned. And then you need just a small $50,000 line of credit to be able to help with the fluxes, the seasonality changes up and down. And so having a line of credit that goes up and goes down, it goes up and goes down, is something that a bank's going to look for, and is something as you as an entrepreneur can think of it, okay, well, if my business doesn't have the ability, isn't it retaining the earnings, it isn't making enough profit in order to pay that line down, then you really need to start looking at it really heavy and say, okay, am I charging enough, or am my expenses out of control because you don't have the ability to pay that short-term borrowing down? Okay, so let's dive into the two components that make up the majority of the collateral for the line of credit. And like I said, every bank and every lender is a little bit differently. So, you may be, depending on your business and the strength of your business, you may be required to pledge additional collaterals for a line of credit. But let's kind of focus on the two major ones. Okay, so let's start with accounts receivable. And so things that you need to think about and you need to be aware of when you're understanding how a bank looks at your accounts receivable. First thing is concentration. And this should be something that you as an entrepreneur are thinking about, whether you have a bank that focuses and asks about this or not. But concentration of your receivables, concentration of your income. Do you have one or two customers that make up 10, 20, 30, 40, 50% of your revenues? If you do, what would happen if that customer stopped paying? What would happen if that customer stopped ordering from you? And you've kind of built up this whole system to be able to support that customer, to be able to understand where your concentration is. And so making sure that you're diversified in your customer base and in your receivable base is really, really important. Number two, your accounts receivable aging. And so that's really looking at and saying, okay, so I really don't want to give net 90 days, but I'm not going to be able to win this contract without getting it. So I'm going to get receivables. I'm going to give the net 90. And so you're going to invoice them, and then you're going to be tracking them throughout the entire 90 days, maybe just touching base with them and, say, hey, is everything going? I know that in 15 days, we've got our invoices due. Are you going to ACH it? Are you going to send a check? Are you going to send a wire? How are you going to get that cash in? And that should be something that your accounts receivable person is having a really, really good conversation and a really good relationship with your customer's accounts payable division. But understanding that, okay, if you agree to 90 days, then you better be paid in 90 days. And if it slips to 91, 92, 95, 100, 120, what are the things that you're putting in place? How are you making sure that you are working together and that you and your customer are being reasonable, responsible, and honest with each other? So understanding that as it ages, and the probability of being able to collect on that goes down, how does that impact you and your working capital? Another thing to kind of think about and to talk through is what banks refer to as cross-aged. So say you have a company and they have net 60-day terms, and you every single month you give them an invoice. And so every single month you've got invoicing that goes out from net 30 to net 60 to net 90 to net 120. Well, what the cross-aged test is they look at it and they say, okay, for this one customer, how much of that accounts receivable is past due, is past the terms? If they've agreed to pay it in 60 days, but they still haven't paid it from 120 days out, well, then if the majority of that receivable is past due, based on, however you define past due, then the probability of being able to collect all of that receivable, it decreases. And so typically that's when you as the entrepreneur are really having tough conversations with those clients. And you really have to ask yourself, so why do I think if they said they were going to pay me in 60 days, but it's been 120 days from invoice number 1 and they still haven't paid me, well, why am I still doing work for them and still invoicing it? Okay, the third thing is sometimes businesses are set up where there's this thing that's called a Contra account, where maybe you're in a situation where you sell and you buy from the other entity. And so if you have $300,000 worth of receivables, but then you go ahead and you buy $200,000 worth of inventory or goods or services from them, then how does that actually work? Do you actually flow through and, did they give you $300,000 and you turn around and give them $200,000? Or do they just kind of net out each other and they only end up paying you $100,000? And so understanding what that is, that's called a Contra account, or, it's kind of washes it out. Understanding how that impacts your working capital and your working capital cycle, especially if your terms and their terms don't mix. A lot of entrepreneurs have multiple companies that do the same thing, but maybe they're geographically different. Maybe you've got a manufacturing plant that's in North Carolina that handles your East Coast distribution. You've got a plant in Texas that handles the South distribution, and then you've got one in Oregon that handles all of your West Coast distribution. Well, each one of those are technically maybe set up as separate companies, but because you have the manufacturing capability, you have the ability to kind of shift production from one location to the next and from one business to the next. And so there's going to be a lot of intercompany or related accounts receivable that might be on your balance sheet, accounts receivable and accounts payable. And typically banks don't like to see that, or they don't like to lend against that because, quite frankly, you could be, I'm sure that this has never happened, but you can say, okay, well, this company owes this company something, and we're just going to be really gracious and we're going to give them longer terms, and so we're not really going to get paid back. It's all intercompany. I own everything all together, so me not paying myself back is not that big of a deal. But from a bank's perspective, especially say it's only lending to the Texas company, that's something that's really significant for them because they want to look at the accounts receivable and they want to get paid back. For some of the larger companies that I work with, they actually do business internationally. And while this may have some really, really good opportunities for you and for your company, you need to understand that international accounts receivable should be treated differently than domestic accounts receivable because there are so many different international laws and perfecting of the liens and what you have to do as an entrepreneur. If someone in Mexico, Canada, Europe, wherever, if they're not paying, then how do you make sure, what is your legal recourse to be able to go back and get that and to be paid? And so with that, a lot of companies that I've dealt with that have done international business, they actually go out and they receive accounts receivable insurance. And you can have accounts receivable insurance on domestic companies as well as foreign companies. It's just really just a matter of saying, okay, in the event that there is some type of dispute or the accounts receivable starts to go bad, then you can have a claim against your insurance policy. Now, I am not an expert on AR insurance, but it is something that I do have a couple of connections with. And if you're interested in learning more about, just send me an email or have a comment in the link below or something. And I'd be more than happy to connect y'all. And really it's about understanding what is the cost of that insurance, and is it worth making sure that you have consistent cash flow and you don't have to worry about that. Now, this next bit, it predominantly is more in the manufacturing and in the construction world than it is anywhere else. But there is something that's called progress billing, where you actually go and you say, okay, well, X amount of this job, I'm a third of the way through this job, and so I'm going to bill for this job, knowing that the job is not complete, knowing that what I've done is interconnected and tied directly to what still needs to get done. And those are called progress billing or progress receivables. And typically from a bank's perspective, again, every bank is a little bit different, but banks typically don't like that because, and I'm not an expert on progress billing, but I have seen instances where there's been a dispute in progress billing, and the dispute in the progress billing, just the way that the contracts are written, everything like that, it's a lot easier for the customer to be able to kind of drag paying you out on, and to very easily say, okay, well, no, I'm disputing that this was a third of the way done, and so I want to have either a third party inspector, or there's some mechanism by which you have that, and until that's done, until this box is checked, I'm not going to pay you. So that receivable that might already be a net 60, net 90, easily gets dragged out to, from your perspective, a net 120, net 150. And so when it's going out there and the ability to dispute the receipt of that is so easy, that's where some banks and some lenders don't necessarily like that. And so you can understand how that is completely different than saying, okay, I have to deliver a carton, or I have to deliver a crate of, toys. And when the crate leaves the dock or leaves my shop and is dropped at your warehouse, you accept receipt of that crate, and then then we agree, okay, the receivable is in effect. You understand, see how that's different from a progress billing versus a standard billing. Okay, so let's talk about advance rates. And not every line of credit has advance rates that are applied to them, but an advance rate is, or a loan borrowing report, or a loan-based report, is a report that you submit to the bank, and your availability on your line of credit may go up or may go down. So you might have a $20 million line of credit, but if, let's say, you wanted to draw more than $5 million of it, then the bank's going to require that you start to submit these loan-based reports. And these loan-based reports is basically you going and saying, I have the assets on my balance sheet to support being able to borrow above the $5 million. So the advance rates on lines of credit specifically for accounts receivable, and again, this is different by every bank. These are just kind of some of the general broad, the consistent things that I've seen talking with not only my own institution, but with some of my bank friends, is that normally it is, you're capped at 80% of your outstanding receivables. So if you have $1 million worth of AR, then you might only be able to borrow against 80% of that. And then they're going to look at it and they're going to say, okay, is there a concentration? Maybe you have one customer that has 30% of your accounts receivable. Well, they may say, you know what, I don't like anything more than 20% for one specific customer. So in that instance, so you've got $1 million of AR, it's already brought down by 80%, but then they go on and say, okay, well, 333,000 of that is with one customer. Well, I'm going to discount your availability even more. I'll give you $200,000 of that available, but that 133,000 that's above that's gonna reduce it a little bit more. And then they're gonna look into see, okay, how aged is it? Are your customers, do they pay you in net 30, net 60, net 90? Typically anything that's beyond net 90 is not excluded or is not included. And so if you have on that $1 million of receivables, if you've got $200,000 of it, that is over 90 days old. So you start to think, okay, what's the probability of collecting that? It's gone down. And so, anything that's above 90 is excluded. But you have to understand your customers, and you have to be able to explain to your bank why, if you give terms beyond that. I've actually seen terms In the agricultural space, you know, obviously if you're like a seed producer or a fertilizer producer, you're going to have to, you know, someone's going to borrow, and they're going to borrow to buy the seed and the fertilizer and everything. And then they're going to need 3, 4, 5, 6 months in order to actually grow the crop, harvest the crop, sell the crop, and then pay you back. So there are instances where banks might be able to get comfortable with going beyond the 90 days, but it's understanding your customer base. Are they strong financially? Do you have financials on them? Is the probability of them paying you back in 180 days really, really good? And so it's just a matter of you understanding that. Going hand in hand with that, the aging, we talked about the cross age. So if you have a significant amount, or if you have more than 50% of your AR to one specific customer is beyond those terms, whether it be 60, 90, whatever it is, then the probability of collecting not only the money, the receivable that's beyond those terms is maybe in doubt, but then all of it is in doubt. So maybe that at that point that gets eliminated. So it's all understanding how your business works, your working capital cycle, and then understanding how the bank that you're working with looks at and provides some type of discount is really super, super important. So that's the first asset that really makes up your working capital cycle. What's the second one? Well, the second one is your inventory. And so there's a couple different things that I would ask you to consider as you're looking at and understanding your inventory, and then understanding how a bank looks at your inventory. Just because your inventory has value to you, it doesn't necessarily mean that it has value to the bank. And so inventory is typically classified into one of three categories. The first one is raw goods or raw inventory. This is billets of aluminum, sticks of lumber, you know, rolls of coal, of steel. You know, this is just the raw material that it hasn't been processed, or if it has been processed, it's processed in a manner that it can be it's a commodity. So there's a really good market for that, and to be able to say, okay, if I have to sell this, if I have to convert this into cash, am I able to do that really, really quickly? And if you haven't touched it, well, then obviously your inventory is raw, and the ability to convert it back to cash is probably pretty good. And that's good for you, but it's also, you know, good for the bank in the event that they have to take care of that inventory, and to be able to say, okay, how do we liquidate that? Is there a market to liquidate it? The second type of inventory is your work in progress inventory. And normally this type of inventory is excluded from a borrowing base or a loan base report. And think about it this way. Let's say that you are a doll manufacturer. You made baby dolls. Okay, so as you're going through and your factory is producing baby dolls, I mean, in a work in progress, and you have this baby doll that maybe has the body and you've got the head, but the eyes aren't glued on, and you know, it doesn't have any hair. I mean, it's a hideous looking doll, but to you, that inventory has money because you are working on it. You are making it valuable. To the bank, they don't want to have some poltergeist looking doll as part of their things that they have to sell in order to pay down the line of credit. So that's why normally work in progress is not counted as part of something that a bank will lend against. And the third thing, so you said start with raw goods, raw material, then you have work in progress, and then you have finished goods. So those are the specific things, the dolls or whatever it is that you make that are complete, that they're able to then go and sell. And depending on what you do, this may be something that can be included in the borrowing base. Sometimes it is, sometimes it's not. You know, and what you really have to look at is what you do, does that have a very specific buyer? Because just like when we talked about with your raw goods, if there is an open market for it, and to be able to say, okay, I can go ahead and I can sell that, then you might be able to have that included. An example of this would be, let's say that you are a t-shirt manufacturer and your raw material is just bolts of cloth. And so that there's a market for that. And then your finished goods is a half-made t-shirt. Well, that's not really good. That can't be sold. But your finished product is a t-shirt that maybe is cut to a specific size or has a specific fit or something. But as long as it's not like personalized, as long as it doesn't have like a Nike or an Adidas or a band logo or something on it, as long as it's not personalized, where you're narrowing the field of people that would pay money for that, well, then maybe that if it's kind of plain like that, that might be included in finished goods. If it says Greg's Crab Shack and you've got 10,000 of Greg's Crab Shack t-shirts, and me as the owner of Greg's Crab Shack is the only person that would be willing to buy that, well, then maybe that market is really, really small. Now, on the flip side, you can probably make an argument to say, well, yeah, well, Greg's Crab Shack is the only supplier, or the only person that's going to buy this. He needs to have these t-shirts in order to sell in his retail store, and so he can't go anywhere else in order to get them. So Greg would be motivated in order to pay you for that inventory. So it's really kind of understanding where that is and understanding how your bank looks at the different types of inventory. Now, as far as an advanced rate goes on inventory, again, it depends upon the market. It depends upon the type of inventory that you have and where it is in the stage of that. Normally I see those somewhere. I've seen it as low as 10%, and I've seen it personally. I've seen it as high as 50. I've actually heard from a couple of clients in previous banking relationships that they used to be able to leverage their inventory up to 80%. And so I personally have not worked with anybody that has done that. But in order to get there, do that, then you have to have a really strong company that the bank's comfortable lending that much against inventory. You have to have a very good system for accounting for inventory, making sure that everything's accounted for, making sure that the value assigned for that inventory is in place, and making sure when you say on your balance sheet that I've got, $78,000 of this of lumber, and then I've got $150,000 of aluminum, and I've got $300,000 of steel, that you've got a really good accounting system and an inventory system to give the bank a high level of confidence that you actually have that. So depending upon your bank and depending upon your bank or your lending institution, you may have to submit these loan-based reports either on a monthly basis, or shoot, I've even heard sometimes some of the stuff is issued on a weekly basis, because the values and the receivables and the inventory changes so much, maybe during like a very specific time frame. But to be able to go and understand when you do have to submit these loan-based reports and at what level. Some banks have it on all lines of credit. Some banks say, okay, at a certain level of line of credit, or depending on how financially strong your balance sheet is, how volatile your industry is, because some industries are just more prone to ups and downs than others. They just are. It's not saying that your company's bad or anything. It's just saying, hey, there's a lot of risk in it going up and down. And understanding your business understands when you have to or may have to submit these loan-based reports. If you get into larger lines of credit, you might have your banker start talking to you about ABL, or asset-based lending. And that's really just your line of credit that's on steroids. And where it is on steroids, it's understanding the structure that is around the line of credit, whether that be from a reporting standpoint, or maybe that's from the understanding of, hey, we've got a concentration limit put in place, or a Crossage put in place, or anything above a certain amount of days is excluded or included. Also, when you talk about a true asset-based lending, you might have some other structures around that. Like you might have a credit line sweep so that your line of credit is tied to a checking account. So anything that is put into that checking account, if you've drawn against the line, it actually gets sucked off and it pays the line down. And I find that a lot of entrepreneurs like this because, one, it gives them availability to access the funds no matter the time of day or whatever the need. as long as they've got availability. But it also, by having it automatically sweep down and pay down, they know that they've got, that they're limiting their interest expense as much as possible. And then there might also be something that's called a lockbox, depending on how you actually get money into your account. It might be like, if you get a lot of checks, you might have something that you have what's called a lockbox, where, you know, like if you have a cable bill or a light bill or something, a lot of utility companies use these, and you send the check in and it goes to a PO box that's someplace else that really the entrepreneur, the business never even sees that. But the bank comes in and they actually have a bank employee that open up the mail. They scan in the invoice, so they know the company and the line of credit and everything the account that is being deposited into, and then that's automatically deposited into the account. And then if you've got a credit line sweep set up, it takes that account and then it sweeps against the line. So it's all about understanding how you get paid. If you don't get paid, if a lot of your stuff is done electronically through ACH or wire or something like that, then you may have, you might have an electronic lockbox and a requirement to have all your money deposited into that specific account, but you may not actually have the cost associated with an actual physical lockbox. So at the end of the day, having the different structures, it depends on the strength of your financial company, understanding your working capital cycle, understanding your working capital need, and then having an open and honest conversation with your lender as to how they structure these types of deals. Well, that's not all I've got to say about lines of credit, but I think that that's a great place to stop. I really just want to thank you so much again for sticking with me over the last 4 weeks. And hopefully this provided a lot of value to help you understand your working capital cycle, and your working capital need. Hopefully I've given you some tools to be able to translate that gut feeling that you have into some actual data, and you're able to use that with your team and to be able to build out not only your growth goals, but your working capital goals, and to be able to say, okay, do I have enough fuel in order to achieve what I want to do operationally? And then hopefully this also provides you with some confidence of going in and saying, okay, if you are growing and if you do make the decision to either take on debt or a line of credit or anything, that you have an understanding of how you can understand how a bank looks at the line of credit, at least at a very high level, but then to say, okay, what's the appropriate amount? Because just because a banker says you can take X amount in debt doesn't mean that you should. You have to put yourself and you have to put your company first, and to be able to say, how can I make sure that I continue to be financially flexible? And how do I ensure that my company is going to achieve my strategic vision and my goals? Sometimes that's with debt, sometimes it's not with debt. And so I really just wanted to empower you and give you the ability to plan out and help yourself. As always, with the end of all of the courses that I have, I just absolutely crave feedback. It would mean the world to me that if you could just give me a note of, hey, I really like this, or this content really was not very valuable to me. Everything from the size of the length of the videos to the workbook to the templates and everything that I've got. Anything that you can get that I can make this type of course more valuable and meaningful to you, I am so humbled and honored that you have given me so much time over the last 4 weeks to actually speak into you and your business. And if I can make it any better, I definitely want to do that. I'm also definitely open to feedback for some future episodes and different types of courses that I can provide. I think that the next course, based on the feedback that I've gotten, and my next course is going to be a little bit different. I'm going to talk, just as a sneak peek, I'm going to talk with 3 or 4 or 5 different experts specifically around preparing your business and selling your business. I'm going to talk with entrepreneurs that have done that. I'm going to talk with business brokers. I'm going to talk with some SBA specific lenders that are experts in helping finance that, so that you can get it not only from my perspective, but you can get it from a lot of different perspectives. And so I hope you look forward to that conversation coming out in the 3rd quarter of 2021. If you have any other ideas, either about that subject or other subjects that you'd like me to expand on, I would be humbled and honored to be able to hear from you on that. Until then, this is Greg Martin, the Entrepreneur's Banker, thanking you so much for spending the last 4 weeks with me. And if you haven't connected with me on LinkedIn or Facebook or anything, please do so. It would mean the world if you sent a like and share this with any entrepreneur that you think would get value out of it. And until we connect and until next time, I hope you have a wonderful day. I hope that you are peaceful, and I hope that you achieve all of your strategic goals.